Hello everyone. Everywhere we hear that risk appetite is back. We hear about controlled inflation, expectations of rate cuts, return of confidence, and the likelihood of avoiding recession are all fueling the return to optimism. We can take many examples to illustrate that, but today let's look at a less usual one. Emerging market debt in Africa. Because after an absence of almost 2 years, sub-Saharan African countries are back on international debt market. At the end of January, the Ivory Coast led the way with 2 bonds maturing in 9 and 13 years. The response was very strong, order books reaching $8 billion for an issue of 2.6. Then Benin followed with a $750 million issue maturing in 14 years. Here as well, plenty of success, order books reaching $5 billion. And it's also worth mentioning that those 2 countries issued at a single-digit yield, between 7 and 8% roughly. But the story doesn't stop there. The market's resilience continued to show on February 12 with the return of Kenya. The country is rated single B on negative watch and is supported by the IMF. Its ability to refinance the June 24 bond has been called into question. The yield of that bond rose above 21.8% in October last year, when risk premium for African countries calculated by JP Morgan exceeded 1,000 basis points. The more favorable context encouraged Kenya to try its luck with a 7-year bond, the proceeds of which will be used to finance the redemption of the June maturity. The country had planned to issue $1 billion, was expecting to pay a yield close to 11%. But here as well, success and order books reaching $5 billion. The country issued $1.5 billion of debt with a yield of 10.4% and a coupon of 9.75%. Okay, let's face it, this is the highest coupon by an African country in 24. It also means that it will increase the interest burden because the coupon on the June issue is at 6.9%. But Kenya has chosen to pay the price in order to reassure the market, alleviate the immediate pressure on its refinancing needs, and also it could buy itself some time by extending the average maturity of its debt. The decision was welcomed by the market. Once the plan was announced, the yield of the June bond fell from 17 to 11%. It's now trading below 8%. The relief will not allow the country to avoid reforms to strengthen its ability to repay its debt, but it does speak volumes about the market's appetite. According to forecasts by Goldman Sachs, the countries of sub-Saharan Africa should issue $4.5 billion this year. The ball is already rolling, and while the risk levels are varying from one country to another, investors looking for yield will find something for every appetite. Thank you.